Welcome to Barchart's series of educational webinars. Today's session, 10 common trading mistakes and how to avoid them. Whether you're a seasoned trader or just starting out in the world of financial markets, it's crucial to understand the pitfalls and the investment errors that can trip up even the most experienced investors. In this webinar, we're going to dive into the 10 most common mistakes that traders and investors make and offer some practical suggestions to help you sidestep these costly errors. Now, from emotional decision making to lack of risk management. We'll explore the key missteps and that can sabotage your trading success and provide you with actionable insights to develop a robust trade plan that maximizes your profit potential and eliminates costly blunders. Hello, everyone. My name is John Rowland. I'm your host today and Barchart Senior Market Strategist. So, join with me today as I share some valuable lessons that I've learned from mistakes that I've made or by observing other traders over the many years of my experience. My goal is by the end of this webinar, we'll have a better understanding of trade plan development, risk management, and driving out emotions from our decision-making process. Now, before we get to that, please welcome my partner and our moderator for today's session, Barchart's Project Director, Gene Baker. Hello, Gene.
Happy springtime afternoon to you, John. It's been a long
Happy
time
spring.
since we've been together for a webinar here.
I know it seems like ancient history almost, right?
Right. So I think you've tapped a really good topic for today to get people thinking about their own trading plans, and I'm sure you're going to share a lot of valuable information with us.
I think so, Gene. I think folks are going to appreciate this in terms of understanding that a trade plan and trading is there's a process to it, and making mistakes is part of that process, but learning from those mistakes is also important. So yeah, I'm excited about today's session.
Okay, well, why don't we get going then? All right.
All right, sounds like a plan. All right, remember today is for educational purposes only, and decisions to buy, sell, or hold, or trade any security or commodity or any other investment involves risk and best made on the advice of a qualified professional. And under no circumstances shall we be liable for any loss or damages that you or anyone incurs as a result of any trading or investment activity that you or anyone else engages in, based on any information or material you receive through barchart.com and or our services. Okay, so what is the number one common mistake that traders and investors make? And that is trading without a trade plan. Now, I believe it was Benjamin Franklin who said that failure to plan is a plan for failure. And developing a trade plan is paramount to your success. And the reason is that a trade plan or failure to create a detailed trade plan will help us eliminate a lot of these common mistakes that traders make. In today's session, we'll discover that most of these mistakes that traders make can be eliminated with just a simple trade plan. Now, a trade plan has multiple purposes. First, it's a living document that is constantly evolving as we traders, investors, grow and change with our experiences. Now, this growth on an individual basis could change our objectives, our strengths, our weaknesses. And as these changes occur, also our trading preferences or our characteristics can change. Now, second, a trade plan should offer detailed guidance for different asset classes, our risk tolerances, our methodology, our strategy, and most importantly, or one thing we're going to talk about is a means to record and evaluate our progress. Now, some things like objectives and goals could be universal, but it needs to become very granular as we trade across different asset classes. Your risk tolerance or your methodology for investing, let's say, in utility stocks will be quite different from day trading commodity futures. Now, I have three styles of trading. I have a long-term wealth trade plan, I have a swing trade plan, and I have a day trading trade plan. Now, each of these has their own set of risk management rules, objectives, and strategies. And finally, probably the most importantly, a trade plan gives you discipline, right? Making trading mechanical. If this occurs, then I do this. If that occurs, then I do this. Not, I wish this happens, or I hope this happens, or I want this to happen, and maybe I'll do this when that occurs. Trade plan will eliminate that emotional aspect and that indecisiveness. I'm going to follow this plan to heart. Plan a trade, trade your plan. Discipline. Now, overtrading is one mistake that many traders make. Now, overtrading can take on many different characteristics depending on the experience of the individual. And common ones are trading too many markets. Usually, this is associated with a personality who wants to be in on everything or be in on all the action. Now, just remember that trading multiple markets means exponential time commitment. The more markets I trade, the more time I have to be committed to watching those trades. Placing too many trades per day or per week or per year. Now, Warren Buffett limits himself to 2 to 3 new trades per year. Again, a part of his trade plan that keeps him from over trading. In too many open positions. Now, obviously, a long-term investor may have multiple open positions, and this would be more relatable to, let's say, a swing trader or day trading, which requires a lot more time commitment and this risk management aspect. And inadequate time spent in analyzing and researching. Right now, if we add up all of these together, and if we're constantly focusing on current market conditions, that leaves a little time to research or discover new opportunities. So maybe part of my trade plan, I will set aside a certain amount of time every day or week or month for research. Now, overtrading can increase your costs through commissions. That's obvious. But it also amplifies your risk exposure and distracts you from big picture goals in pursuit of, say, short term gains. Now, what we want to do is we want to define what we consider to be overtrading and create a strategy part of our trade plan to help us avoid these common mistakes. So, I limit my long-term portfolio to 15 to 20 stocks. I just feel like that's an easy number for me to manage over a longer period of time. Plus, that gives me a good diversification in terms of risk exposure of one single stock. 2 to 3 weekly swing trades. That's the many as I will trade. Now, that could be an outright weekly trade or it could be an options swing trade play. But the more balls you kind of juggle, the greater the risk of you dropping one, right? So in other words, you might forget about one of the markets you're trading, or you might miss something because you have too many markets that you have to pay attention to. And that would increase our likability of we're going to make a mistake. So these two, the next two, 3 and 4, risk management and stop loss. Now I've added these together because I believe they go hand in hand, risk management and stops or stop losses. Now, risk management is definitely one of the most critical aspects of a trade plan, but it's often one of the most forgotten or ignored. Risk management rules and proper position sizing can trip up even the most successful or seasoned trader. And I see this a lot. I see a lot of traders who just kind of jump into trades without even having a plan, right? Or like, well, where are you going to get out? Where's your risk reward? What's your risk? What's your downside? What's your upside? Right? They just, I'll get out when I feel like I'm going to get out, right? That's not a plan. You wouldn't jump out of an airplane without a parachute, right? A stop. And you wouldn't also do that without some kind of form of trading, risk management. And so trading is no different. Risk management rules should accomplish at least one of 3 purposes: eliminate risk, manage your exposure, or profit from taking on risk. Now, you can never really eliminate all risk, right? That's obvious. But let's say I'm not going to trade a low volume stock. That eliminates risk, right? Let me give you a great example. Just recently, I was trading a bank stock. I saw a setup that I love, something that I've seen many times before. I wanted to get into that stock, and I jumped into the trade without doing some risk management. Now, what I found out was that this stock only traded about 200 shares of volume a day. Now, it was easy for me to get into the trade, but once I got into that trade, and even though I was using very tight risk management rules and stops, because of the lack of volume this stock traded, by the time I got out of the trade, I gave back over half of the profits that I had in the trade. So using that risk management rule of not trading a stock that has a low volume would eliminate a lot of that risk and also help me manage my risk exposure. So stops are a straightforward risk management tool that it can help us accomplish all 3 of these purposes: eliminating us in getting into a market, or eliminating a massive catastrophic loss based on some kind of event that I'm not aware of, managing my risk exposure, in other words, limiting the amount of risk that I'm going to take on, and also, using a stop to protect my profits as the trade works in my benefit. A stop to get out when I'm wrong, a stop to lock in profits, a stop to protect me from unseen events. Now, from my experience, traders for the most part do an excellent job of finding trading opportunities. They do a poor job on exiting trades. So anytime we add a rule of risk to our trade plan, we want to make sure, does that rule perform one of these 3 tasks? In other words, these 3 objectives. Now, I'm just going to give you a couple common or general rules that you can use in terms of your trade plan. So don't risk more than 2% of your trading equity per trade, right? Not on all of your trades. And to keep your position size under 5% of your total capital. Now, I know a lot of traders, including myself, at many moments in time, which will use what is called a 1-2 rule, where they only risk 1% per trade, and they only use 2% of their total capital. So somewhere in between there, I think, is a good general rule for risk management. Now, why do traders do so poorly in executing exit strategies? Well, that's because they have something that's called loss aversion. And loss aversion is a financial behavior whereby individuals hold on to losing positions for too long and exit winning positions too quickly. Now, losses are part of risk taking, and that's what we have to understand in terms of trading. Right? You can't. Nobody is going to win every time, and especially different types of strategies. For instance, a trend following strategy, you're going to discover that you're going to have more losses losing trades than you are going to have winning trades. So it's important to understand that risk management, in this case, losses, to avoid some of these big losses. And that's why it's important for us to understand these risk rules or the stop loss rules, and also learning how to hold on to winners, because one large winner can make up for a lot of small losses. So again, maximizing our winners can't be achieved without a proper trade plan to guide us on exiting a trade. Now, recently I did a webinar with Jerry Parker, who is one of the original turtles. And I learned something from Jerry, which was pretty interesting. He uses a risk management tool called the turtle channels. Now, if you're not familiar with the turtle channels are, it's basically just on your charts, it's going to show you what is the highest price over a certain look back period and the lowest price over a certain look back period. I'll just show you where you can find that under our studies, uh, turtle channels here. And what I've done here is I have a template that is created that uses a 40-day look back period and a 55-day look back period. And so what Mr. Parker talks about is he uses this to help him to hold on positions for longer periods of time. In other words, he won't get out of a trade until price goes to the lower level of his turtle channels. Now, I have NVIDIA up here, so let me just kind of blow this up a little bit. And let's change this to our time frame a little bit, squeeze this up a little bit. I just want to show you three scenarios that ran out with NVIDIA using this turtle channel risk management tool. In other words, how to hold on to winning trades for a longer period of time. So you can see back in March of 20 here, depending on where you got in, this trend carried out for a long period of time. And under Mr. Parker's rules, he wouldn't have gotten out of this trade until price engaged his lower turtle channel, which would have happened in March of 2021. In other words, he would have been in this trade for over a year, even though multiple times you had price swings where you would have maybe been losing money or given back some profits. But here's how he would stay into those trades for a longer period of time. Notice again here, depending on where you got in on this trade, using the turtle rule, you would have stayed in this trade for, it looks like, about 8 months before that price got back to the lower look back turtle channel. And again, here's NVIDIA, of our recent price movement. And yes, again, depending on where we got in, let's say down here or even on this low here, we are well above the lower turtle channels. In other words, we'd still be holding on to a winning position. But again, as each trader evolves, each trader's risk tolerance is different. It might be difficult for us to sit here at this moment in time if we were long NVIDIA and say, okay, yeah, NVIDIA is trading $269 or $270, and I'm going to stop myself out when it gets down to 204. That might be a difficult or emotional process that many traders would find that difficult to do. So you might have other risk management rules. You might have a percentage that you would give back, or a dollar value that you would give back. But what I'm trying to point out here is that if I have certain rules, then I follow those rules regardless of the results. And then I let that trade play out based on how I set the trade up. And in the case of Mr. Parker and his turtle rules, you can see that he does give up short-term gains in terms to gather a much longer-term performance. In other words, modifying his trading plan so that he can hold on to large winners for a longer period of time, which will offset a lot of his smaller losses. And that emotional part of trading is probably the most difficult for us as traders. And this is very hard to overcome because we're humans, right? And money is a huge driver for our emotions. Fear and greed are powerful emotions that can cloud our decision-making process. Acting impulsively on these emotions instead of having a rational analysis can compound our losses and put us at risk. What we need to do is learn to train ourselves not to concentrate on absolute dollar amounts. We want to think about trades in terms of risk to reward, percentages, ratios, mathematical, right? Mechanical. You almost want to become like robots because trading and investing uh, involves this thorough research and this patience. And it's boring. I'm telling you that trading is boring, right? If you want excitement, go to the amusement park. But in trading, we want to think about trading as a business. And that business is increasing our personal wealth. Right? We're not looking at it as an opportunity to gamble. So there's a lot of waiting, right? Now, I'll mention some things here. So, I don't want to be swayed by financial news, right? On news networks, our Jim Cramer types of the world, right? Those are designed to play upon your emotions. Now, if you have you're a long-term investor and you see a story or you see an opportunity that you like, or you create a thought or an ideal based on a trade, based on a story that you saw, you know, you want to wait to jump in, right? So what you might do is you write in your trade plan, you say that you're going to wait an X amount of time before you put that trade on. Now, for me, I use a 48-hour rule or 2 days trading because I know in the long run that I'm not going to worry about missing out price that happens over the next 2 days, because in the long run, right, that 2 days is not going to make a difference on a trade that I'm planning on to hold for, if I'm correct, for 6 months or 3 years or whatever. So I'm not going to worry about that FOMO or that emotional aspect of terms of part of my trading. Again, I want to make trades very mechanical and emotionless, and I want to use things like mathematics to help me decide when and where I'm going to take my trading opportunities. So that leads us to mistake number 7. And this one is telling the market what to do. And I notice this a lot, that traders and investors can become very opinionated regarding the market analysis. They look at all these different technical analysis, they look at things and they believe that they know exactly where the market is going to go. And they tell the market where it should go. instead of listening to what the market is telling them. And so technical analysis is a very valuable tool for us, identifying trends and potential reversals. But the key to good technical analysis is to look at markets through multiple time frames. My process is I use a higher time frame to tell me where price has been and where it could go, that path of least resistance. I use an intermediate time frame for my trend analysis, right? How is price going to get there? And then I use a lower time frame to help me manage entries and exits, to help me lower my entry costs, and to help me find signals of potential changes in my trend. Notice that in my process, my higher and intermediate time frames determine my decision-making process, and the lower time frame helps me in my timing, my risk exposure, my entries and my exits, and not the other way around. So here's the NASDAQ, and let's kind of walk through this process together in terms of multiple time frame analysis. Now, I'm here on a weekly chart. It is weekly chart. Let's make this a little bigger here. And what have I done here? Well, first of all, I just drew this red line here. It represents this downtrend that we've been in, that we were in most of all of last year. And you can see that it looks like, very obvious to me, that we have now broken this downtrend. And as we have broken this downtrend, we've now made a new high, a new higher low, which is the signs of a beginning of a new uptrend. So if I want to invest in the NASDAQ or NASDAQ component stocks, I feel like the market is showing me opportunities to look for buying opportunities. In other words, to take on risk. But I still need to analyze where price has been and where can it go. So right now I have these two red lines. One represents an area of recent resistance and past resistance. But if price gets above this level of resistance, then it feels like it has room to run to this level of resistance. Now, currently, we are right up against this level of resistance. So in the big picture, maybe I want to wait for price to re-engage my uptrend or in a level of support before I take a long trade. Now, if I go down to a daily time frame, and there's still my red lines that represents my downtrend and my uptrend and my level of support. Now I'm saying, okay, here is an uptrend that I like, but now I'm going to wait for a better trading opportunity that is closer to this level of support and nearer to my uptrend. So I want to look for an opportunity somewheres inside of this red box. So this is where I'm thinking, well, I want to be long. So now what I'm going to do, I'm going to go down to an even smaller time frame. Here I'm going to go down to a 1 month data set with 60-minute time frames. And I'm going to say, okay, here's this box where I want to start looking for trading opportunities. And where do I find a trading opportunity? Well, I see a little gap here. I love gap trades. So I would probably look for an entry right around this level. But what I can also do now is I have a trading tool that is called a risk reward. I'm going to click on that, and let's say I'm going to enter on this gap fill, and I'm going to risk this bottom of this box, which was that buying opportunity, and then I'm going to set my target at my near-term resistance. And I can look at this trade and say, okay, is this a trade that I want to take, where I'm going to get a 2.76 risk to reward return? If that is not a good enough risk reward return for me, then what do I need to do? I either wait for a better opportunity, maybe lower, maybe down closer to my trend line, or I need to set a target that is greater. Now, the secondary target that I saw around 13,000 would give us a greater risk reward ratio, but I have to respect that higher time frame resistance, right? That the market has been bouncing off of. This is why we use multiple time frame analysis. Many traders would just jump into this trade because they're saying, hey, we're in an uptrend, but they're taking on a lot of risk for a very little bit of reward. So this big versus small, big time frames versus small time frames is part of this multiple time frame analysis. Those who focus only on one specific time frame, that can be fatal. And recognizing that higher time frames can influence lower time frames, but also lower time frames can alert of possible changes in higher time frames. And this is paramount to technical analysis. There's big time frames versus smaller time frames. Now, I had a trader, an old trader friend of mine, who told me this. And he said that remember that big time frames lead to big profits and little time frames lead to little results. And you can take that as it is, or you can take it as how you want to read that. It could be little results meaning small dollar values, or it could mean that little results in terms of greater amounts of failures. And I'm sure that there's individuals in this room right now who are going to watch this and say, hey, I trade 5-minute time frames and I make money. And I understand that. And God bless you. What I'm saying to you is that multiple time frame analysis, where we look at all time frames, higher, intermediates, and lower time frames, is a more successful way of doing trade planning, risk management. And that brings us to point number 8, which is lack of knowledge, research, and preparation. We just went through this process of doing proper preparation, doing our research, right? Looking before you leap. Too many traders jump into trades without understanding the risk of the fundamentals or how that particular market works. In other words, what are the different potential risks of that market? Now, I'm going to give you a really good example of this one. When I was working on the New York Mercantile Exchange as an energy trader, the exchange opened a new energy contract, an electricity contract. And the president of the exchange, was going around asking guys, including myself, to go in there and, help support this new contract and trade these electricity contracts. And so it's like, I thought I'd do my part, and I went in there and I started trading some of these different electricity contracts without understanding, the fundamentals or the risks that these electricity contracts had. Now, one of the contracts was something called the California-Oregon border, which was a hydroelectric contract. And once a year, what they would do is they opened up the flood gates for the dam that allowed the salmon to get past the dams. It was called a fish flush. And on that week, or when they planned on doing that, based on the salmon run, that could fundamentally disrupt the hydroelectric power that was being created. I think it was the Columbia River Gorge or someplace out between California and Oregon. And that would disrupt electricity prices. And I didn't know about that. And fortunately for me, though, is I had a electricity position on and came during one of these fish flushes, and the market moved $11,000 per contract. Now, thankfully, I was on the right side of the trade. But the point being was that, there was a huge risk that I was not aware of, a fundamental risk of these contracts, and that I just traded these just, to be part of the team, so to speak, and not understanding that risk. And I'm going to tell you, from that moment on, I didn't trade any more of these electricity contracts until I understood what risks could be involved. But this is a good point for traders here. Is, a lot of us might be familiar with options or futures markets, but understanding what those risks that could be based on the volatility or the price movements of those particular contracts. So one of the things you can do in terms of looking at markets is, for equities markets, you can look at something called the beta, the relationship of a stock's price movement to an underlying index. In this case, let's say the S&P. But you can look at volatility through the lens of something called implied volatility, which is options, or price movement through a tool that's called average true range, or ATR. So here's a watch list that I have. This is 23 stocks for 23. This is a webinar that we did in the beginning of the year. And I have a custom view that's based on unusual volatility volume. And notice in here, I created a couple of these data points that I was just talking about, percentage change or volume percentage change, but there's an implied volatility, historical volatility, the implied volatility rank, the beta. I can also look at, in terms of volatility of a market by the sentiment, how many puts or calls are being traded. So again, these are kind of just some tools that you can use in terms of looking at an individual equity to help you define or discern what volatilities or the risks that could be involved. And the other one that I talked about is average true range, which can tell you how much that price of that stock could move potentially in one day's trading process. So research to examine if the stock fits your risk tolerance, right? If that is a high beta stock or a stock that has an average true range of like $10, that takes a lot of risk for you to get into a trade. Maybe you will look for those stocks that have lower betas or lower average true range, or an implied volatility, that is more manageable, and not one that is trading at 100% volatility. And this should be part of our pre-trade, pre-planning, before we actually go into trading these markets. So that brings me to another point, how we can improve on this knowledge and this research is we can do what is called paper trading, or we can pretend trade for a while. And this is an excellent way to gain experience in terms of market price movements, that volatility, and that risk management. Now, once I paper trade for a while, then I can look at the results that I've gotten. I can look at the price movements, and I can do something called back testing. In other words, I can check my strategy to see if it's successful and how successful it is. But there is a caveat to back testing that you need to be aware of, is that, in back testing, you get a lot of perfect executions. And that when you go to real live trading, you might not get those great perfect executions. In other words, you have to have lower expectations of your results when you start to go to live trading. Now, there's also that emotional aspect too. When you're paper trading, you don't feel emotionally attached in terms of winning and losing. But once you start putting your own money online, I guarantee you that your heart is going to skip a couple beats, and you're going to start feeling that emotion of putting money to risk. So another part of knowledge and research and preparation is that Barchart is a great tool in terms of helping you with this process. First of all, on our main page, you can look at, what news stories are popping up that could be driving the market. We offer, and we do this for options, ETFs, and futures, currencies. Give you some investment ideas, how you can start managing or researching, trading opportunities, and news. A lot of news. We part of our process, a part of our website, market news today, a bar chart news. We have a Twitter account that tells you about, what is the hot topic or what is going, what are other traders are looking at it. That's something that interests you. And also under news, we have a lot of featured artists. I think our authors. We have a lot of great authors that put out material, a couple times a week or daily, and they really dissect the markets in terms of technicals, in terms of fundamentals, in terms of historical perspectives, and also a lot of these traders have many, many years of experience that helps you to gain knowledge through their experience. So a great tool in terms of using Barchart itself, in terms of that research and preparation process. And so again, that educational aspect, the webinars that we do on a weekly basis are another great tool about different trading ideas or trading setups or strategies. Just think about today's webinar, just this food for thought about how to develop a more well-defined trade plan. So that brings us to point number 9, and that's failure to adapt. And markets are dynamic and always changing. So what worked today might not work tomorrow. And market conditions such as bull and bear runs can change on a moment's notice. So we should be constantly evaluating our trade plan and our strategies, and that is crucial to our success. Now, notice how I say here that we're going to evaluate our trade plan, not necessarily change it, right? We want to let our trade plan run out for a while. I think when we talked about that paper trading, a good number, I think, is, you want to see like 50 trades through your trade plan before I start making adjustments or making changes. But if I have 50 trades and then I have another 50 trades, and then during that second 50 trades, I start noticing some different results, then that might give me onus to start to make some adjustments. Not major adjustments, maybe just some minor adjustments. But think about this too. As you're creating your trade plan, as you're creating your strategy, you might be developing and testing your plan during a bull run. And then today, we might be in a bear market. So if you're a trend follower, right, then you might have different results, or you might have bearish results. Or let's say currently, we look at market conditions currently, I think the market, for the most part, is showing the signs of a bull market, but it really has been trading sideways for a long period of time. So trend following systems might not work during this period of time. So what would that mean to us in terms of our trade plan? Well, maybe we would cut back on our position size. Maybe we would wait for better trending markets. Maybe we modify our risk tolerance. Instead of taking 2% risk, maybe we only take 1% risk or 0.5% risk, until the market starts to acting into the process of how I developed my trade plan, or the optimum trends or price movements that I want, that are going to benefit my trade plan. So once a month health check is a really good way to stay on top of potential changes in your trade plan and your strategy. So what I want you to kind of do is I want you to watch for changes in your equity line. Now, if you don't know what an equity line is, that's basically a summation of your P&L, or your profits and losses. or you have an occurrence of more losses. Again, if I'm a trend follower, which I am, I know that I'm going to have more losses than I have winners. But if I start having a lot more losses than winners, then that might be a sign to me that my markets are trendless, sideways, and that might tell me to, maybe I need to step back, or maybe I need to pause or take notice that I'm waiting for a trend to develop. Now, it's also important to analyze the sizes of your losses, not only in the number of losses you have, but if you start having larger losses. And that also could mean that you're taking on too much risk for those particular markets. And all of this can serve as an early warning sign that your trade plan needs some adjustments. So let me give you some examples of that in terms of how we can determine this process, right? This failure to adapt. And how do we do that? Well, this is one of the common mistakes that traders do that I don't see a lot of traders doing, this matter of fact, is they fail to maintain a logbook. Now, the purpose of the logbook is multifaceted. First, it documents all your trades. It includes trade-specific details, and it can provide you with a record of, your winning trades and your losing trades. Now, the logbook allows you to learn from your mistakes and also to grow from your strengths. In other words, learn from what you did wrong and profit from the things that you are doing right. Now, in turn, that will help you change your plan or refine your strategy. Now, a logbook should also include pre-trade thoughts, what you were thinking about when you took the trade, and after the trade is done, some post-mortem adjustments. What things that I could have done to make that a better trade. So don't underestimate. This is a very, very powerful tool, and this is definitely one of those mistakes that I see a lot of traders and investors don't do. They don't keep track of their trades. How can you remember about a good trade a year ago or 2 years ago? How can you remember the details of that trade without a trade plan? So one of the great things that Barchart offers is if you go into our portfolios, right, and you can create any portfolio you want based on trades that you put in. Now, this is a portfolio that I did for a webinar we did in the beginning of the year for the Futures Trading Guide. It was based on a portfolio of hypothetical trades that were based on the Trading Futures Trading Guide trading system. And, I just put in these trades based on when the Futures Trading Guide gave us a signal to enter or exit the market. But notice here where it says notes. If I go to notes, here's where I can do that edit of transaction. In other words, I can start to make those detailed inputs based on what was my action? Did I buy or sell? What was my entry date? What was my entry price? How many shares or how many lots did I buy? What was my exit date? What was my exit price? And then what I really like about the portfolio here is that's this part of this logbook. But here's where I can make those notations, right? In this case for gold here, my first notice date was January 31st. That's usually a time where we want to exit a futures position. What was my maintenance margin? How many dollars that I had to maintain in this position? Why did I take the trade, right? I entered because the Futures Trading Guide here says it broke out from a downward trend resistance, and then I exit the trade after an engulfing candle broke recent support and during the rollover period. In other words, during the first notice day. So that was my notation. So now if we go back in history and look at the chart, now I'm going to go to flip charts here, right? Here's the November 7th, where the futures trading guide gave us a buy signal, and you can see that it came after price had broken out of all of this resistance. And you can kind of see here, this looks like a downward trend line. It broke out above that downward trend line and gave us that buy signal. And then the other two green ones were, and for the webinar, what we did was where we added on to our position. But what we did was we exit the trade after this rally had been going on for a long period of time. And then we got this engulfing candle, which kind of warned us that there was a change in trend. And then the next couple days, what did we see? Well, then price broke below a level of support. And that was a time for us to think about exiting the trade. Now, not only why did we exit the trade, because price failed to get back above where this engulfing candle was, but it was also coming to the time when we needed to roll out of this position. So it just made sense in terms of this trade, why we exited the trade. Now, I wouldn't remember that. I wouldn't remember all these details if I just saw the net result of the trade. Here, I can actually go back in time and see the trade, look at the chart, look at why I took the trade, and I have those notations that allow me to say, what could I have done better? What could I have done to improve this trade? Now, in this particular trade, probably nothing, and that's fine. But I still have that information that's available to me. So again, one of the mistakes that many traders do is they don't keep a logbook, and a logbook is a very powerful tool in terms of how we can grow as individuals and how we can learn from our mistakes and how we can see what trades work for us and what trades didn't work for us. So I'd want you to really think about that in terms, if you're not currently doing a log book. All right, Gene, I do have some takeaways I want to talk about, and I do see some questions here. So give me a moment here so I can kind of review some of these questions that are on our site today.
John, while you review the questions, let me just remind everybody that if you want to play around with a portfolio, start adding your notes for your logbook, go ahead and create an account on Barchart if you haven't already done so. We offer a number of different memberships. You can just do a free membership, which gives you access to the portfolio, or you can sign up for our Barchart Premier membership. We have a free 30-day trial, and you can try out all the different additional things that you get with Premier, including running screeners on your portfolio and watch lists and a lot of advanced types of reports. So if you don't have a Barchart account, go ahead and try it today.
Okay, thanks, Gene. Yeah, we'll mention that as we leave. So let's see. I got a question here from Ron. It says it's interesting. He wants to know of only trading a handful of markets and knowing them extremely well. Yeah, Ron, I think that is a great plan. I kind of feel like, I might trade multiple equities markets, but it seems like I fall back into the same 5 or 6 or so stocks that I've traded for many, many years. One of the ones I've talked about on many occasions in our sessions is Alcoa. I know the behavior of that market. I know its tendencies. So yeah, I think there's a lot of relevance to becoming a master of a few instead of a jack of all, right? Certainly when I was a day trader, I felt very comfortable trading a very few select futures markets, a 10-year note, a couple currencies, Australian and Canadian dollar, the energy markets, which is where my background was, gold. I felt that when I was trading outside of a lot of those markets, that's when I was having losses. Now let's go back to this logbook idea, Ron. That what I also noticed is in terms of a logbook is many times, and so let's talk about equities for a second here. And when I was trading equities, or when I'm trading equities, because of my logbook, what I discovered was that many times that the good trades that I put on were ones that I put on late in the day or close to the close, and that a lot of my profits came overnight. In other words, gaps and movements in the price, or I was able to identify a good trend that had been created during that day, and then I jumped into that trend. But I also discovered that a lot of my good results in terms of exits I found were executed in the morning sessions. So when I trade equities now, I try to look for good opportunities late in the day as we get close to the close. And when I look to take profits, or when I look to get out of a trade, I usually get out of those trades in that first move, right after the opening. And that was one thing that I learned from my logbook. Now, when I was a day trader trading futures markets, what I also discovered was that many of the trades that I were successful were ones that I created in the morning session. In other words, in the first couple hours of the trade. And that if I didn't have a winning trade, let's say by 11 o'clock, that first 3 hours from 8 o'clock in the morning to 11 o'clock, that there was a higher probability that trade was going to be a losing trade. So what I learned from that is that by 11 o'clock, if that trade wasn't a winning trade, regardless of what happened after that, my trade plan rule was I exited the trade and I looked for a better opportunity the next day. And I didn't worry about what happened after that trade. Yeah, maybe that trade could have gone up and made a profit, or maybe that trade could have gone down and had a loss. It's just from experience and from my logbook, I realized that there was more probability that if I did have a winning trade that I put on in the morning that was not giving me a result by 11 o'clock, there was a higher probability that was going to be a losing trade. And again, to your point, Ron, is what I also discovered was there were many futures contracts or stocks that when I was trading them, that I was having more losses. And so what I do is I don't trade those ones. So that's an important process that we need to do, and where I can learn that from my logbook. So Dan asked the question, strategies for being stopped out of trade. So Dan, I have several webinars, how to create a trade plan, how to look for exit opportunities. Look for those ones. I'll show you those in a second, where you can find those in our archives. But, again, a very simple rule is a 1-2 rule. In other words, I'm only going to risk 1% of my trade equity. If I have, let's say, $100,000 worth of risk capital, then I'm only going to take a 1% loss on a trade. So then what I can do is, let's say, I have $100 stock, right? And if I buy 100 shares, what's that? $10,000. So what would I take a $1,000 risk? Well, I would allow that stock to fall, $1, right? That would be my risk, right? So there's a lot of ways you can do that, but I still would hold that 1% of my trade equity as my rule of risk. So Ramon sent through a question. Ramon, I'm reading your question, and it seems a little distorted to me. So maybe send that through again. But you asked, how do I put a stop loss when I have not put the first moments after a downtrend? So I'm guessing what you're saying is, how do you define risk, let's say, in a long position when you have a market is making a downtrend? Again, why we need to have a trade plan, right? So let's say we are going to look at a downtrending market that we want to do a buy breakout. So where would my risk be? Well, it would probably be the most recent low, or if I'm doing a breakout trade, the low of the candle that broke out of my area of resistance would probably be a good stop loss. If I'm doing a retracement or a pullback strategy, which I was kind of showing you in the NASDAQ example, then maybe it would be the most recent swing low would be the level of where I'm going to risk, where that trade looks like I'm wrong, where that trend has changed, or where that trend that I'm trying to predict a change of trend, where that trend is back in control. So where would that be? Where it breaks a recent low or a swing low would be a great point for a long trade versus a downtrend. So Walter asked, how much in terms of percentage stocks should go up to sell it? Again, Walter, that depends on the trader's goals and their objectives. If you're a swing trader and you can get a 3 to 5% movement in a market where you've only risked a 0.5% or 1%, well, now you're getting a 3 to 5 to 1 risk reward ratio. Is that a good enough return for you for a swing trade? I think that is a good enough return for you. If you're a long-term investor, right, what are you trying to do? Well, you're probably looking to, a 25% or a 20% appreciation over, a course of a year, or an X percent appreciation over a multiple years. Here's a really good guideline that you can use is, if your trade plan and your trade executions are not beating the indexes, in other words, let's say you're putting on positions that are only getting 5% return or 8% return, and the index does a 10% return or a 12% return, then you're probably better not being an active investor and being more of a passive investor and just let the index do it for yourself. All right. All right. So I'm at the top of the hours. If I didn't answer your questions, I apologize. Send your questions to support at barchart.com. We have a great staff who will answer those questions for you. And if they can't answer them, they'll pass them along to me. So some additional food for thought. Other common mistakes, the lack of diversification. I think that is pretty obvious. Adding to losing positions. Don't add to losers. Now, there's a difference between a scaling into a trade. You're looking for a total area where you want to start adding risk, versus somebody who buys a stock at $50 and then goes all the way down to $20. And he's like, oh, if I liked it at $50, I got to love it at $20. That's not good trading. Poor technology and platforms. Make sure your software is up to date. Make sure you have a good computer. That will pay off in the long run. If your computer is 15, 20 years old, maybe it's time to update your computer. Gambling, right? Don't gamble, right? Don't bet on red. Don't bet on black. Don't bet what pundits are selling you. Oh, the market's going up, right? If you're going to gamble, you might as well go to the casino, because at least you get free drinks. Emergencies. If you have a personal emergency, or you have a health issue, or your dog got sick, right? It ate the paper or whatever. That's probably not a good day to be making investment decisions, right? So, be aware of that. Mental check-ins. If you have a series of a lot of losses, or you feel like the market is kind of beating you up, it's important to stick to your plan. But there's also a time where you have to say to yourself, maybe I need to take a day off, or maybe I need to sit out of the market for a while, because the market is telling me something that I'm not doing it right. And again, an old adage that I was taught by an old trader is, don't worry about missing out on a trade today, because the casino is always open, and the markets are always open, and there'll be opportunities, every day. The market is open. There's always a bull market. There's always a bear market. So don't feel like you're missing out. So if you're not 100% engaged in what you want to do, maybe it's a day to take off. And lack of discipline, not following your trade plan, right? Plan a trade, trade your plan, all right? Stop losing, stop learning to lose, and learn, stop losing, and you'll start learning how to win. All right, so Gene has mentioned, we have a 30-day trial process. You can come in and try out a lot of these tools, a lot of these option screeners, other properties on the website. I would recommend that you try it. And let's see what we got coming up. So under archives, again, I mentioned to you that that's where you can find some of those previous webinars. For today, you can see our 10 most common. Again, if you go onto that, click on that one. Up here, you can get our PDF files. All of our Wednesday webinars will eventually show up on our YouTube page. You can go there and look for them as well. And next week, we've been away for a while, Gene. I forget what we have for next week. Oh, we don't have
Right.
one for next week. Oh, we do
No,
have one for next week, but
right. If you
go
go
ahead.
to the upcoming webinars tab there, John, we have a special session next week. Actually, John is not going to be leading the session, but one of Barchart's popular news contributors, Gavin McMaster, is going to talk a little bit about our Barchart for Excel product. It's a separate subscription, separate from the barchart.com website, that allows you to use Excel to pull data in and do all sorts of really phenomenal, crazy, different kind of things with it. So if you're an Excel person, this might be something you want to take a look at. Gavin will be joining everybody at noon next time in our regular webinar spot.
Great, Gene. Yeah, for those of you who want to do back testing, Excel is definitely one of those tools that can help you do that back testing part of your trade plan analysis. All right, folks. I hope you enjoyed today's session. Be safe out there. Be healthy, and the good of all trading.